Hello, I'm Emma Wall, and joining me today is Sebastian Lyon of Troy Asset Management to talk about balancing capital preservation with opportunities for growth. Hello, Sebastian.
Hello, Emma.
How do we invest off the back of such great gains while still having opportunities for growth?
So I think that 2019, to some extent, was borrowed off 2018. 2018 was a weak year. Markets were down about 10%, and particularly in the last quarter, a very weak markets. And so the Powell pivot, the Federal Reserve's change in monetary policy in January of last year, really set up markets for a very strong growth, which we saw really through to August. And then from August to December, it was a little bit more messy. But you're absolutely right, Emma. The markets are in a very mature bull market. We've had 10 years of effectively unbroken gains with a few wobbles along the way. Valuations are high in equities, boosted by very low interest rates and very low bond yields. So investors, to some extent, have had very little choice other than to go into equities in order to make their returns. Today, we are more cautious than ever. Back in 2009, we were 75% in equities. Today, 10 years on, we're around a third in equities. So we really have battened down the hatches. But having said that, there are opportunities within the equity market. I think in particular, what's important is to avoid the horrors. So to avoid things like retail, which, as we've seen in the last few weeks, post-Christmas, we've had a lot of warnings. People's expectations were low, but even those have been dashed by trading, which has been very weak.
And I think that's an important point to make, because investing is not binary. Just because we've had a great run in equities doesn't mean you should put all of your money in bonds and alternatives. There are still opportunities there to make gains, but it's about balancing that portfolio to, as you say, avoid the horrors.
And also where the opportunities are. So I think in moving to the cloud, Microsoft's been a fantastic performer for us since 2010. It's our largest holding. That tailwind is still there from the point of view of electronic payments. So we hold Amex, but obviously Visa and MasterCard have done well. Those trends, there is a very nice sort of tailwind behind them. And as I say, avoiding the retailers rather than not necessarily going for the very expensive retailers, but you can sort of avoid the downsides of those other difficult areas. So essentially you need to get the balance right between where those opportunities lie still and where growth is still there. But being very careful, I think, particularly at this stage in the cycle, about valuation, not getting too carried away.
And the other two-thirds of the portfolio, how do you balance then that equity portion that you've talked about with the rest that's on offer to investors?
Well, I think the real issue about this cycle is that correlations are very close. So bonds and equities are less of an insurance than they have used to have been. In the past, having bonds and equities together, sort of cheek by jowl, was a wonderful way of diversifying a portfolio. When economies were weak, then bonds did well. When economies were strong, equities did well. That's different over the last decade. And so we don't hold a lot of fixed interest, barely any, very, very short dated. What we do hold is index links and US tips in particular, where we can pick up a real yield, a positive real yield, in a world where real yields are moving more and more negative. And one of the reasons why markets were strong last year was real yields went more negative, and we saw obviously negative nominal yields in Europe. And the other way we've done it, which I've discussed with you in the past, is through gold, which has actually done very well since I last was interviewed by you in, I think it was May 2018. Gold price is up around $200, maybe a little bit more. It was about $1,300 an ounce. Very friendless back then. It's found a bid. It's begun to perform. I think that's partly due to that change of monetary policy, that move away from the expectation and perhaps hope of normalization of interest rates. The Powell pivot really put an end to that. The only central bank that was normalizing rates was the Fed. That is now no longer the case. And so gold really has found a strong bid, and obviously geopolitical risks which have occurred over the last few weeks, have exacerbated that. So that's still a helpful diversification when equity markets have been weak. Gold has performed pretty well. So it's not just about the return that we've generated over the last year, which is sort of a short 11%. It's how we've generated that return with low volatility and with gold sort of offsetting what's happening within the equity market.
Sebastian, thank you very much.
Pleasure.